Welcome to Pep Talk, where we discuss the state of Texas real estate market as it relates to property taxes. Here's your host, Paul Pennington.
This is Paul Pennington, and this is the latest episode of Pep Talk, and it's my distinct privilege to have Mac Bottom on our show today. I've known Mac for how long?
At least 20 years.
20 years, and Mac is a appraiser, an MAI, and we're going to put some information up about Mac and his firm. Mac has been involved in valuing real property, doing market value appraisals on real property, but he's also been involved in doing appraisals for what the slang term is E&U, equal and uniform. These are appraisals that taxpayers get when they want to contend that their value is not at the median level of appraisal of other similar comparable properties. And so for when you're in litigation, or if you're going just to an ARB hearing, you might enlist an expert, which Mac is. Now Mac is kind of unique that he's been an expert witness not only for appraisal districts, but he's also, I think that most of his work now is representing taxpayers. And he's been doing it a long time. He's been involved in some substantial property tax cases that I know. And I think the most recent case was you were involved in the valuation of an office building in downtown. Was it an office building in downtown Dallas?
Yes, Fountain Place.
Wasn't that like 3 or 4 years ago?
The trial was, I think, about 2 years ago.
It was during the pandemic because it was all Zoom. Okay. And I watched that, by the way. So that was an interesting case. So today, since I have Mac here, we want to discuss something I think is rather interesting. In my career, which has been 40 whatever years, I've seen the ebbs and flows of the real estate market in DFW, Texas at large. And I've seen, like in 2008, 2009, 2010, we had the great financial recession. Mm-hmm. We saw a loss of value, especially in residential properties, but in commercial properties. And I watched that. But what I saw, I was talking to you the other day about this, was what I saw that was so unbelievable to me was the run-up in the values of commercial properties in 20 and 21. That the run-up was something I've never seen. Mm-hmm. And I've been doing this since 1979. I've never seen a run-up in value like that. But you know, it burnt off, and now I think we're looking at a new environment, especially because, and we've had economists on here, and we've talked about, you know, what the Fed's been doing. I think today some numbers came out about what the inflation rate is, and I think the consensus is don't look for a cut by the Fed in March. So whenever they're going to cut, it's not going to be in March. So we're at a point where the Fed rate's high, which, you know, turns into the 10-year rate. So with all that in mind, I thought we would, first of all, talk about E&U. I mean, in the past, I know for a fact that you've worked for the Collin County Appraisal District. You were their expert witness, right?
Yes.
Did any of those ever go to trial?
Not that I testified in.
Okay. And then I know that you did a lot of work for the Tarrant Appraisal District.
Yes.
Did any of those go to trial?
Yes, an apartment complex in Grapevine went to trial.
Went to trial.
Mm-hmm.
Were there any other appraisal districts that you did work for?
That went to trial?
No, that you just did work for.
Oh, yes. We've done work for 12 appraisal districts.
12 appraisal districts
Mm-hmm.
over the year. Are you still doing work with them, or?
We have we have 2 active cases right now or 2 active appraisals that we're working on right now.
Which counties would that be?
Wise and Hopkins.
Really?
Yes.
That's interesting.
Yes.
Kind of out of the Metroplex.
Yes.
Do you still do work for the Tarrant Appraisal District?
Yes, we did an assignment for late last year.
Okay. That's what I always like when I would go to you and I have been to some interesting ARB hearings together. And I always like taking you as my expert because I could be in front of the ARB and say that this gentleman has represented both sides. And I thought that added credence to the number you came up with, which we were trying to obtain. So.
Well, Paul, from our standpoint, it doesn't matter who the client is.
True.
We solve the problem the same way. And then if it helps you, so be it. But we're not in the business of helping people. We're in the business of calling the value as we see it.
You refer to yourself as umpire. You call balls and strikes.
Yes.
But I'm just saying, from my point of view, it always made me feel good that my expert had represented both sides, so that the appraisal district couldn't infer that you were just producing a value, for the taxpayer that was, leaning more in favor of the taxpayer. I always like that. So as we sit here today, February 29th,
Yes.
2024. That date doesn't come around very often, the 29th of February.
We'll have to do another podcast 4 years from now.
4 years from now. And so anyway, I thought it'd be interesting to do a podcast and discuss just the lay of the land for equal and uniforms that you're currently doing in this area, say for taxpayers or whoever you're doing it for. Now, I think we're going to discuss office properties. But before do you want to lay a premise out for just a real global statement about when you do a equal and uniform appraisal, what it entails?
Sure. Well, equal and uniform appraisals are subject to the Texas Property Tax Code 4226A3. And so the methodology is defined in that portion of the tax code. And essentially, there's three main steps. First is to identify a reasonable number of comparable properties. And courts have ruled that around 7 is reasonable. But at times, we've done senior living properties in a county where there were 4 or 5. So those are the comps, and you have a right to be equitably assessed against those. So once we identify the comparable properties, we then apply appropriate adjustments based on generally accepted appraisal techniques and methods. And so we adjust for location and physical elements and economic elements. And then at the end of the day, the value is the median. So in a typical market value appraisal, we might say the subject property is better than all the comps, so we're going to conclude at the higher end of the range. Under the equal and uniform, it's the middle number. So it just kind of defines how the methodology is done.
You need, after all these adjustments are done, the subject property needs to be assessed at the median level of appraisal for a reasonable number of comparable properties which have been appropriately adjusted. That's the value that a taxpayer can get under the code as it's written today.
Yes, and in a normal sales comparison approach, the starting point is the sale price. Mm-hmm. In this instance, the starting point is the assessed values for the comparable properties.
In other words, when you do these studies, it's like you're doing the sales comparable approach to value, but you're not using sales, you're using tax assessments.
Exactly.
Okay. All right. So, well, let's get into it.
Well, one thing I did want to say, Paul,
sure.
is, the majority of our work has been equal and uniform appraisals for probably the last 5 to 10 years.
Okay.
We're seeing a transition now in that a lot of the requests are including both equal and uniform and market value, and or just asking for market value. And I think that reflects that market participants are knowledgeable that capitalization rates have risen, in part because, or due mostly because of the interest rate increases.
Right.
And so, they're concerned that the appraisal districts are not recognizing the reality of the market, which is that values have gone lower.
Right. So we've had other podcasts where we've discussed the one class of property that's just, again, I've never seen. I mean, even in the RTC, maybe not as bad as RTC days, but this is horrific. The office market.
Yes.
And, we've been told that, to try and get like just financing on a deal to buy a multi-tenant Class C or a B is pretty hard. And the equity requirements, the amount of money you have to put in these deals are very high. And then everything that we hear about office, I mean, everything we're reading about office, I mean, nationally, if you're talking about what's being said, say, in the Wall Street Journal or locally, what's being said in local publications, it's terrible.
Yes.
And it's unfortunate that the office market is suffering from the effects of COVID. People stopped coming to the office, and then there was this whole thing. I know that people in that industry said, well, when people come back, to the office, maybe tenants won't want as much space and these kind of things. And then the cold, hard truth is some of these tenants didn't come back, And so it's a horrific story. So if a appraisal district or a taxpayer comes to you and they're looking at, we need to know what the value is on a office product, you're saying today they might say, we actually want you to tell us what the equal and uniform value is, but we actually want you to tell us what the market value is, because that might be lower than the equal and uniform. And that I have never seen.
No, and I will say, Paul, we haven't gotten into that yet too much to know where our values might shake out in relation to each other, because this is kind of a new trend in the market, so we haven't really got to the point where we've completed those analyses to really compare them.
Well, I can tell you that what we're doing here at my firm is we've made the determination that what you do for a living is the past. Mm-hmm. You agree with that?
I do.
Economists and appraisers look back. And so what I'm seeing is like we're being told by some of our clients that own office product that the bank are doing appraisals on a routine basis. Now, the problem with the bank appraisal is it's lease fee.
Uh-huh.
In Texas, everything has to be it's supposed to be value fee simple.
Yes.
And these lease fee numbers that we're seeing are horrific. I mean, we're looking at, what the value was in 23, and we're looking at these lease fee appraisals, and there's a big delta. Mm-hmm. And so in some cases, I might be typical of some of the people coming to you. I'm saying, we're not going to do a equal and uniform this year. We're going to do a market value appraisal. Are you seeing that?
Some, yes. It seems like a lot of people are asking for both. We just put out some proposals, so we'll see if they choose one or the other or both.
That's an expensive proposition.
I
mean, because to get a market value appraisal on an office building it's substantial, and then you have the added cost, the normal cost of an equal and uniform. So very, very easily, whatever your costs were for appraisal services, say in 22 or 23, would be double.
Yeah, or maybe more, because we charge more for a market value appraisal than we do
Right.
for equal and uniform.
Right.
So
Absolutely.
yes.
So, okay, so let's get into, tell me what you're seeing in market then.
Well, we've talked.
Or in office, I'm sorry.
Yeah, in the office market, the big stories are the market is bifurcated. You have the really top-end properties, close to amenities. Basically, I describe it as things that a millennial will like. And those are doing well, and there's investor appetite for those. The majority of the market, though, is comprised of B and C assets. And they are the assets that have really been hit hard by the pandemic and then people not returning to work. There was an article in the Dallas Morning News today about a building in Plano in the Legacy Business Park. And the broker in that article stated that there were 50 buildings in far North Dallas that had at least 50,000 square feet or more available. So right now according to CoStar, we have about 89 million square feet of office space available. And that's a vacancy rate of 17.8%. Now CoStar, that's also a 20-year high for the Dallas market, Dallas-Fort Worth. CoStar projects that vacancy rate will increase to 25%, CoStar says that that's a 25% increase from 2019. They also believe that by 2025, the vacancy rate will be 21%. So CoStar is a very recognized market metric that's relied on industry users. So the office market is really in a tough pace. And the deals that are being done from a leasing standpoint are smaller deals. And like I said, they're gravitating toward the newer, better quality buildings. Some areas like the Star, the Link, those areas, and Granite, Uptown, those areas are doing pretty well because they have the amenities and proximity that tenants want. But we also have a lot of CMBS debt coming due. So I think in 2024 it's $790 million coming due. So there's a lot of signals of distress in the office market, and it looks like it's going to get worse before it gets better. So JLL announced that they're going to tear down what was a kind of a small medical office building on Central Expressway in Richardson and build a 390-unit apartment complex on that site. So we're starting to see these properties being repurposed. We know that some of the downtown office buildings are being converted to residential and hotels. And it's just, I love it when the market cites an appraisal term, and that's functional obsolescence. And that's what the market is calling these older and less competitive buildings. So I always have to brag that we invented that term. But so in a nutshell, the office market is in distress. There's not a lot of buyers that want to buy. You can't get debt. And because of that, it's really hard to know what a cap rate is today, because the other thing is people might argue, well, the sales that have occurred are distressed sales because they had to sell.
But if that's the market.
Right. It's kind of like the RTC days when
That's the market.
that was the market. And so we're trying to see what the inflection point is right now. And but I think most people that are thinking about selling are seeing the prices and saying we better just hang on to it for now.
So you brought some charts, and we're going to put them up on the screen. This first one, why don't you walk us through what this first one is for office? And
Yes.
DFW, by the way.
Yeah, DFW. This is a market cap rate graph that CoStar prepared. And what this shows is that, all classes of office space, including all classes in Dallas as well as in the United States, the capitalization rates have increased pretty dramatically. And that reflects both the risk in the market, but also the higher cost of debt, if you can get debt.
Yeah, looking at this chart, it looks like the C and B, that their cap rates are at 9 or above, and then the the higher quality properties in DFW again are just a tad below 8.5-ish, low 8s.
I think the best quality is a little between 7.5 and 8.5, or 7.5 and 8.
Okay, and that would be okay.
But what CoStar, another interesting part of this graph is that CoStar is projecting that those will continue to increase.
Yeah, they go up in 25.
Yes.
I see
And
that.
that makes sense, really, if you think about it. If the vacancy rate's going to increase, that's more risk in the market.
Well,
So,
according to this graph, even if you're the higher quality office building in 27, you're still going to be north of 7.5. You'll be north of that in 27.
Yeah,
So
8%.
yeah, okay. Let's go to another category. Just let's go back to equal and uniform. Now, have you had anybody come to you and asking for your services, and they go, we want a market value appraisal versus E&U, or most of your work still E&U work, appraisal reports?
I would say mostly they're asking for both. So we haven't so far had just market value. I mean, we've had a couple inquiries. We did not get those assignments, but so it seems like a lot of folks are asking for both right now. Maybe just to get guidance, and maybe because they want to see it both ways to see if one or the other helps them better.
Okay. We didn't mention that, back to the office space, that based on the Texas Property Tax Code, it needs to be fee simple.
Yes.
So that would take all the historical rates, it would not apply. It's what would the property lease for on 1/1 of 2024.
Yes.
Which is going to be starker than what it would lease for in 21, 22, and 23. Okay. So
Yeah, what that kind of means, Paul, is that the rent roll is above market.
right. And that's why you would get a fee simple appraisal. Say, if it all leased up on this day and we stabilized it, whatever the stabilization rate is, this is what it'd be. I agree. And the cap rate would be substantially higher.
But the other thing that it could be an outgrowth of this market is that I've seen investment memorandums and things like that, and talked to buyers, and even though the vacancy rate in Dallas was always higher than 10%, everybody always tended to project 10% of the vacancy and collection loss. It'll be interesting to see if, because we have so much vacancy, and that doesn't count the sublease space, which is substantial.
Very substantial.
So it'll be interesting to see if, when sales start occurring again, if buyers are projecting lower stabilized occupancy rates.
Yeah. All right, let's go to, I think multifamily is the next. So tell me what we're seeing for cap rates on multifamily. And I guess we're also, and we'll throw this chart up as well. Where do you see cap rates for, let's just call it C's, low B's? Where do you see that right now?
Well, the best quality is now in the 5 range. Mm-hmm. So usually it's 100 or 150 basis points between each class. Mm-hmm. But cap rates are up 100 to 150 basis points, and we're in a situation where the market's oversupplied, because we delivered 32,000 units.
Because of that's an outgrowth, I think, of the surge in prices, the pandemic. Hey, we sold it, let's build some more, and so on and so forth, right?
Yes, because of the strong growth from 2020 to early 22, everybody had projects underway.
Right.
But we delivered 32,000 units, and we've only absorbed about 14,000.
Okay.
So the vacancy rate went from 6% in 2021 to 10.4% now. So a 4% increase in the vacancy rate, and as a result of that, over 30% of the properties are now giving concessions. Mm-hmm. So, rent growth was negative last year.
Really?
Yes, it was, according to CoStar, it was 1.4% negative, whereas in 2022, it was 4.4% positive. So, because of and that really reflects the top end of the market, the newest properties, because they're competing with the ones that are being delivered. Mm-hmm. So, there's the market is still in good shape, and because of the tremendous job and employment population growth that we have, people are not too concerned about the multifamily market. This is kind of a maybe 1 to 2 year kind of hiccup, and then people expect that it will get back to more normalcy.
So let me ask you a question. I think the banks are. Because I told you the story of I had the retail developer, multifamily developer, and I've said this many times, the old formula was you buy the dirt, you build the building, you get a little operating history, then you sell it. During the period of time that you and I are talking about, that went out the window. You buy the dirt, you start building the building. When you're at 85% complete, you had contracts. And those things sold for enormous prices. And what I see is that people who bought in that period, there's two kind of people who bought during that period. There was the people who just looked into the sunset and it was blue sky forever because everything around them was blue sky. But then there are other people who looked at it and said, it's blue sky, but we're long-term investors. We stay with a property, 7 years or whatever. These short-term guys who went in there and they said they're going to add value by doing whatever, and it's going to, okay, so now they're in a problem because they bought high, they put money into the deal, and in my opinion, I'm hearing a lot of talk about it's not worth that. It's not worth the high price plus what you put into it right now, and that's what I'm hearing.
Well, yes, and in 2021, there was $26 billion of apartment transactions in the Dallas-Fort Worth market.
$26 billion.
$26 billion was the gross added up sale price. You know that last year it was $7 billion. So, that kind of underscores what you're talking about, that, that the sales have dropped off, which means there's a big bid-ask difference.
Absolutely.
And I have a very good friend who's an apartment broker, and he says that last year all they basically did was work on valuations for prospective sellers who then decided not to sell.
Right.
So the one thing from the investment market standpoint, unless the interest rates do decline, there will probably continue to be a bid-ask spread unless the owner has financial problems and needs to bail out.
Well, there's my question on these short-term players who didn't go long-term on their financing and their rate adjust. All of a sudden, these rates the adjustment could be significant. Their holding costs now could put them upside down.
Mm-hmm.
And I'm surprised. We've seen some foreclosures that have been, we've seen groups of apartments that have been foreclosed on. I'm surprised that we haven't seen, or maybe I'm missing it, that we haven't seen a significant uptick in foreclosures in multifamily, or have we?
There was a kind of high-profile one that just was announced, and that's the Gabriella. Mm-hmm. It's a pretty new complex, and it built by a well-recognized developer. Mm-hmm. So they may have gotten into exactly what you're talking about and got hit by the interest rate increase and maybe they decided to just give it back.
I know that I talk to people, I have people that contact us all the time asking us to help underwrite the taxes. And I think I told you I have one client, we'll do 2 or 3 a week, but they're not closing. That's kind of what you're saying, because after you do the underwrite. Okay, so for multifamily, we're saying that the cap rates are up, vacancies are up, concessions are up.
Yes.
If I look at this chart, and you're saying in the short term that the peak of this seems to be 2025.
Per CoStar, yes.
And then it starts to trend down.
Yes.
In 26 and 27.
Yes.
Okay.
And get back to kind of, cap rates got really compressed.
But on this chart, 26 and 27 is still higher than 18.
Yes.
Okay.
But remember also,
might be the new normal.
18 to 22 was just such a
crazy
bull market in Dallas that cap rates really got compressed. Yeah. There was more demand than supply, and that caused prices to go up and cap rates to go down.
All right, let's go to another category. Industrial. We did a podcast. We've been doing this. We've been doing this for over a year and a half. And I remember being told at one of my first podcasts that industrial was the darling, not multifamily. And then the person told me how much industrial space we had in Dallas. And it was like 1 billion square feet. It was just, it blew me away.
Yeah.
And so I'm coming from industrial, is it still the darling?
It is still one of the preferred asset classes. However, there's a little turmoil in that market as well as a result of developers building too many buildings. I mean, last year we had about 69 million square feet delivered. Think about that, 69 million square feet of warehouse space in one year. But we only absorbed about 27 million. And so the vacancy is at 9%, a little bit north of 9. And that's 3.2% higher than 2022. So that's a pretty big uptick in vacancy. And, rent growth is still strong. And that kind of reflects that dirt prices are higher and construction costs are higher because of materials are higher. We have not enough labor. So, they tend to track construction costs because same thing with sales. I mean, we had $11.2 billion of sales in 2022. We're about 7.8% now, 7.8 billion now. But that also reflects that there's been some pretty big portfolio sales. So, Prologis bought the Duke, and 45.
That was huge.
Yeah, 45 of those 673 assets were in Dallas-Fort Worth. So I would say that the industrial market is still a good asset class. I think it's a lot like the multifamily market. We've gotten ourselves, as Dallas tends to do, in a little bit of an oversupplied situation. But most people think because we are in a great location, preferred by distributors, that we'll work our way out of that inventory and things will get back to normal.
So looking at industrial, if I'm looking at this correctly, cap rates for 2024 would be in what range for?
Well, per CoStar, a little about 6.5.
Well, you have different categories. You
Yeah.
have specialized, logistics, flex. With logistics, we're looking at a cap rate that's just shy of 7. Does that sound right?
Yes. But remember, this is all the transactions that they track.
And the number of transactions are down.
Yes, they are.
Okay.
But of course, if you have a 100% leased building to a credit tenant for another 20 years with annual escalations, that's going to trade on a lower cap rate, right?
And then flex looks to me be around 7.5.
Yes.
So industrials is kind of the same. It sounds like, are we seeing concessions, a little higher vacancy?
Yes, there's always been, it's been typical to give maybe a month free for the term of the lease. And those have ticked up a little bit for some. Walmart gave back a 1 million square foot building that they occupied in South Dallas because they built new buildings that are more highly automated. So I think they kind of shrunk their footprint a little bit because of automation. And so that could be a trend that we see for other users in the market, that if they can use robots and conveyors and those things, they might be able to downsize.
Is Amazon still on the big buying frenzy that they were a couple years ago?
Amazon is vacating some properties nationwide. So, it's still a good business. But I've read that they have been giving back some warehouses that they have, and that just could be that they're improving functionality.
And they're out of the pandemic, and online shopping's just not through the roof. Okay.
It is at my house.
Yeah, when the Amazon guy, doesn't matter who the driver is, the Penningtons, we know how to get there.
Yes.
Don't worry about it.
They don't even need a map.
So, and then finally, let's look at retail. And it looks to me, based on your chart, that retail, it sits. Let's just like, if you're a mall, let's just get malls out of the way.
Okay.
There is no future in the mall business. Is that safe to say?
You know what's interesting? I would tend to agree with you.
North Park,
right.
the exception.
Right. But anyway, you know that the mall occupancy in Dallas-Fort Worth increased in 2023?
All I know is the mall in my neighborhood, which is Willow Bend, they're repurposing that.
Yes, yes.
So that's whatever the story is there.
That one's been kind of, I don't want to say troubled, but it's struggled.
Right.
Ever since it was built.
Right.
And of course, there were 2 malls delivered at the same time.
Exactly. But besides malls, what are you seeing in retail?
Well, you asked about a darling. I mean, right now, retail is kind of the darling. In Dallas-Fort Worth, there's about 200 million square feet per the Weitzman Group, which is one of the premier retail brokerage firms.
Right.
We are at 95.2% occupancy, and that is the highest occupancy rate since they started doing studies in the 80s.
Again, is this a function of the, we were in COVID, nobody was building retail, all of a sudden we're out of COVID, people are going to the store again, and boom, we have the supply-demand things out of whack, so occupancies are way up. Basically, is that what we're
That's
saying?
exactly what's happening, because as opposed to multifamily and industrial, where we add a lot of supply, in retail, people wanted more space, but we're really not building that much. I mean, I think right now in Dallas-Fort Worth, there's about 850,000 square feet of retail under construction. And last year, HEB built 2 grocery stores, and that represented 25% of all new construction in the Dallas-Fort Worth area. Think about that, 2 grocery stores. So, when we're adding 100,000, more than 100,000 household or people every year, that just doesn't seem to keep up. So
what are the cap rates doing for retail?
Well, they've kind of stayed low. They've kind of stayed pretty steady. And of course, the darling of that group is the grocery anchored centers, because they're doing very well, because everybody still goes to the grocery store, everybody still goes to the next door nail salon, they get their dry cleaning. Those things have stayed really strong. Power centers were not viewed very favorably, but they're doing better now. So what we're kind of seeing is, despite the interest rate increase, trades are happening in the retail sector, and the cap rates have not increased like the other property types. And why that is, I can only say it's because of the very favorable market conditions in Dallas-Fort Worth.
So if we recap the 4 classes, office unless you're AA, have all the amenities, you have a difficult future in front of you.
It's kind of in a downward spiral.
Right, and that looks bad years out. And the cap rates are high years out. Vacancies high years out. Then multifamily, you're saying that the cap rates are up, the concessions are up, because there was, during that 2021, there were no concessions. It was like, it's a privilege if you get to renew your lease kind of thing.
Except for some new lease-up properties would give you stuff to get full.
Right. So concessions are up in multifamily, cap rates are up, vacancies are up. And then industrial, it's up, cap rates are up, but the surprise of the conversation is retail. Retail.
Yes.
Now, let me ask you this. When you do your equal and uniform reports, which category, just in the last year or so, what category do you get the most requests for? Is it office, multifamily, industrial, or retail?
We don't do many industrial. We do a few of those, but it seems like maybe those values are more straightforward, and so the parties can come to an agreement without needing to get an appraisal report. We do a lot of office. Well, if I were to rank them, I'd say we probably do apartments are number one, office is number two, retail number three, and industrial number four in terms of number of assignments.
Let me ask you another question. Over the last 10 years, has the request for your services on equal and uniform, gone way up, or is it did it hit a peak and it's just kind of been steady? How's that doing?
It's been an upward trend.
Upward trend.
In terms of requests, because we only have so much capacity.
Right. So more and more taxpayers or appraisal districts are asking for the equity report.
Yes, and that I think reflects a little bit of a phenomenon in the appraisal industry, in that several of my primary competitors have now retired or left the business. And attorneys and tax consultants and people that I talk to say that a lot of the younger appraisers don't want to get involved in litigation type assignments. So I think it's, like we talked about, a supply and demand situation there, where the demand is increasing because the number of assets in Texas is increasing. The number of appraisers is static or declining.
When you work, this kind of an inside baseball thing, when you are hired by an appraisal district, are you hired by their attorney or by the appraisal district?
The attorneys.
And when you represent a taxpayer, is it you're hired by the taxpayer / consultant, or are you hired by the attorney?
Almost always the attorney.
Really? Okay.
We do have some people that inquire about our services, and we advise them that they probably want to retain an attorney.
And the reason people would want an attorney to retain your service is what?
Just as kind of the go-between, and also probably because of attorney-client privilege.
Okay. All right.
I think that if you hired me, Paul, all of our correspondences would be discoverable. But if an attorney hired me, then they're protected.
And then the nasty truth that nobody talks about is sometimes you are hired and then you are not asked to publish your report.
Yes.
What would cause that?
Well, all of our assignments are structured as a two-phase assignment. So phase one is you pay us enough money for us to do all the work that it takes to come to a value conclusion. At that point, we report that to the client, and they say a lot of things. They say, okay, thank you. We don't need that report.
Okay.
And we've had that on both sides, where we've come out higher than the assessed value for both appraisal districts and taxpayers. Sometimes they tell us things like, well, we've got an offer that's better than that. So don't publish that report. And then sometimes we don't know why, but they just don't want the report. Or I do know one client I do work for uses another group to do market value. We do equal and uniform. And so they're probably comparing those two to see which one they want to proceed with.
Okay. All right. Well, anyway, Mac Bottom, it's been a pleasure to have you and have this. The great thing about doing this podcast, you know what it is? I get to talk to smart people. That's a big deal to me.
Today I got to, too.
And so as a reward for being a smart person who talked to us on our pep talk, you get an official pep mug.
That's great.
That's all you get, but there you go.
Well,
something to remember the event.
I appreciate it, and it's good pay.
Yeah.
I would like to say one more thing, if I could, Paul. We've talked about the four major food groups today, but our practice includes other types of assets. We do quite a few senior housing facilities, hotels, self-storage warehouses. So we've done land. And we do appraisals not just for property tax disputes. We do them for pension funds. We do them for estate taxes.
Right.
We do them for financing. But most of our work is property taxes.
Do you enjoy the property tax?
I do. You know, I've been doing it so long, I know almost all the players,
Yeah.
and it's always interesting when somebody who I'm doing an assignment with is deposing me,
Yeah.
and that happens pretty often.
And when you get deposed, do you see, do they stay professional or can they turn ugly?
Virtually all of the property tax attorneys that I've encountered for either the appraisal districts or the taxpayers are very cordial.
Good. That's
Yes.
important.
Yes.
All right. Well, thank you, Mac Bottom, and thank you for joining us on our latest episode of Pep Talk.